Dah siap.
Pandainya. Murid-murid, sini. Kalian semua dah sedia dah untuk rumah terbuka kita?
Dah. Jadi kita belajar sama-sama, Okey, nombor 1. Korang buat elok tau. Kalau tak ada remang nanti. Nombor 3.
Puan, lot ini bos kami dah beli. Dia tak kasih buat aktiviti kat sini tau.
Apa-apa pun tak nak.
Cik.
Hei, Puan! Sekarang ni tempat bisnes aku. Bukan tempat untuk kamu semua main-main. Faham? Aku dengar kamu orang tak letak dokumen yang lengkap. Tak tahu datang dari mana. Kalau mau belajar, kamu pergi cari tempat lain. Diamlah. Jangan buat bising. Customer aku sudah komplain.
Saya faham Cikgu Siti. Tapi budak ni tak ada sijil lahir, tak ada dokumen.
Tak bagi budak-budak ni pergi sekolah kan? Tak apa. Biar aku je yang dekatkan sekolah dengan diorang.
Boleh tak saya tukar apple ni dengan buku tu?
Yang ni? Boleh je. Alah. Tak apa, awak simpan je apple tu, okey?
Betul ke?
Betul.
Terima kasih, Kak.
Okay, so A untuk?
Apple.
B untuk?
Ball.
C untuk?
Cat.
Walaupun dia tak ada dokumen, Cik, dia tetap ada masa depan.
Peraturan tetap peraturan.
Kalau dah tak ada jalan lain, Cik, memang masa depan budak-budak ni tertutup selamanya, Cik. Budak-budak ni tak minta kemewahan. Dia cuma minta peluang. Kalau maksud sebenar raya adalah untuk buka pintu dan hati, inilah masanya tuan-tuan dan puan-puan. Untuk kita buka pintu untuk mereka ni semua.
Bos, stok kita terbakar sebab ada orang buang rokok. Kita kena cari tempat lain.
Mr. Lim, saya nak jemput awak ke rumah terbuka hari raya nanti.
Bukankah itu maksud sebenar raya?
Pergi! Pergi!
Dulu aku fikir sekolah untuk yang ada. Cikgu ajar ilmu untuk semua. Walau datang tanpa nama, di sini kami semua diterima.
Haji, bye-bye, bye-bye. Tempat ini tempat ini nama orang pakai je. Tapi jangan bising sangat.
cikgu, okey? Ilmu yang kita ada, kita kena kongsikan dengan semua.
Tahun depan boleh tak saya ajar budak baru?
Boleh.
Terima kasih, cikgu.
I want one of my kids in Chocolate to become the future leader. They can be proud of themselves telling that I'm the street children that came out from the Chocolate. And I'm here to change humanity. I'm here to change how people live. Okay, done.
Okay, morning everyone. Welcome back to Morning Kappa at 8. I'm Joseph here. So looking at the Hang Seng Index over the week, the index remains below 20 and 50 days moving average, showing that the bearish setup remains intact. Now, in this juncture, we'll set our stop loss at a 2,750 point level. Despite the Hang Seng overall technical setup remains bearish, over the week, it did attempt to stage a counter trend rebound. We can see that the rebound was led by 700 Tencent, 9988 Alibaba, and also the 883, which is a CNOOC. Right, as of this morning, right, we do see there's trading opportunities on the CNOOC, and also another Hong Kong stocks, which is a 941 China Mobile. Okay, and just have a quick hang on. Just have a quick update, right? We can see that the this week one of the event will be the US Fed Watch, which is the what's the Fed is going to mention about the outlook of the interest rate, and we can see that the last track is that the consensus tends to believe that this year, right? At the end of December, right? The rate could be fall between 350 to 375, which means this year there may no rate cut, or there will be a maximum one rate cut, right? Anyway, this expectation is still very dynamic. Depends on the outcome of this Iran war, and also the US this tariff rate. So I think we'll just continue to watch the development of this. But we do know that right now, right, as you can see over the weekend, right, Iran continue to close the Straits of Hormuz. Right, we can see that the WTI crude have surpassed $100 US this morning, and meanwhile the US bond yield is actually rising at a very faster pace recently, with a rising bond yield, right? The COMEX gold, right, has experienced selling pressures. So the smart money tends to move into the bond, which is a safe haven. And also the bond does give a bit of interest, and the yellow metal was testing the 5,000 level, and the support level for overall setup will be at 4,008. Okay, and as for the S&P 500, over the week, right, the index has been undergoing a very strong selling pressure. This week, you attempt to stay above 6,006, the stop loss point or the major support. Now, falling below this 200 days moving average, or this 6,006, right, will further dent the market sentiment, and we shall see the selling pressure to increase, right, once the index falls below 6,006 support level. Right, and over the week, you can see that majority of the component stocks does experience selling pressures, apart from the memory counters that have a little bit of a counter trend rebound over the week, right? And as for Malaysia, our benchmark index, KLCI, still trade above 20-week SMA line. Major support is marked at 1645. Now, last week, the money flowed into the healthcare, right? Especially the glove counters, right? We do see that the plantations also garnered the foreign funds, as well as a bit of energy. Now, meanwhile, the financial, technology, and consumer, right, experienced a different degree of selling pressure last week. Right, FKLI will still keep bearish bias with our stop loss point, right, marked at 1720. Right, as long as the FKLI stay below 1720, or the 50 days moving average, this bear will have the technical advantage. FTPO continue to experience the rebound. It went continued above their 4,005 level. The stop loss point will set at 4210. As long as stay above 4210, we'll stay on the bullish bias on the FTPO. Now, meanwhile, a few counters that I do see opportunities since the oil price are still moving upwards. Firstly, the P10, right, post to a break past 4.75 cents. The next resistance will be 5.40. Now, downside support will be look at 3.30. So as long as stay above the 3.30, I think the uptrend will continue. Right, for the last week, Iftar have upgraded Burma's auto in the buy. Right, I can see that the stock have reacted positively. At one point, it break past 89.5. So do take a look at our latest upgrade, Burma's auto, which have technical chart show bullish momentum so far. Now, for another petrol-related counter is hibiscus. I do see that the technical setup remains bullish, and this is the only upstream counter that is a direct proxy to the oil price. So if the oil price stay at a high level, technically speaking, hibiscus should have deliver positive returns, or market sentiment remains positive. So the support level will be marked at 1 ringgit and 85 cents. Next, R1 will be at 2 ringgit and 40 cents, and followed by R2 2 ringgit and 70 cents. Okay, as for the Trading stocks this morning, firstly, we have D&O Technologies, break past 52 cents resistance, R1 60 cents and followed by 58, downside support 44. Then on we have the Supercomnet, eyeing to break past 55 cents. If a break happen, now Scomnet will be testing 60 and followed by 65 cents. Downside support is 50 cents. So we have breakout stock D&O and pending breakout Scomnet. So I stop here and pass on to Yong on the Rasa Meng. Thank you.
Thanks, Joseph. Let me share my screen. So, good morning, everyone. I'm talking about our weekly market outlook. So, looking across our recent sentiment index again, we'll see the proprietary index continue to show suggest a continued downside risk. You can see the blue line here, continue to point toward we are close to a niche risk neutral zero level here. So, this basically tells us the growth downside bias for global equity and risk appetite has been declining, and we continue to stay cautious and defensive, where the hard crude oil price expected to wait on the global equity and the growth. So we also did some analysis based on the recent shock from the oil, and we see that a 10% increase in energy prices will slow down the global GDP by 0.1 to 0.2 percentage point and lifting the inflation by 0.4 percentage point. So in short, persistent elevated oil price increase for more than 3 months will be the first pointers where we start considering a negative implications. So while we look across our asset allocation strategy, we still preference to be overweight on crude oil and gold in the short term, but expect some moderate support from the dollar index, especially when the tension persists. Separately, we continue to market weight equities. We can see the equity flow as well as neutral on IG bonds for diversifications and exposures to growth-related funds if the conflict noise faded. So with further escalations of the geopolitical tensions likely to let the Brent oil price higher toward 140 per barrel, US dollar barrel, and also the gold price may move toward 5,500 level US dollar per ounce. However, in the longer term, we still remain quite structurally optimistic. We still hope for the current Middle East conflict to last between 4 to 6 months, 4 to 6 weeks. Should this come to pass, we remain hopeful that negative impact be short-lived, where the confidence will return and also global growth will return to expectation earlier at 3.5 to 3.7% in the 2026. We still advocate to look past, look beyond the geopolitical tensions and stay cognizant to other structural risks. So first, we saw the US-led tariff risk, AI bubble, and also inflation, where we actually point out before the coming of the geopolitical tensions. So on tariff, there's a new fresh news surrounding the potential Section 301 of the Trade Act against US trading partners, including China, EU, Mexico, India, and Japan, as well as ASEAN, including Malaysia, Singapore, Thailand, and Indonesia. So this may lead toward a more bearish tone in the coming weeks, where we suspect this could be one of the replacement for the Section 122 tariff adjustment has been made earlier, which is 150 days. So after this come to pass, we think the 301 could become a legal basis for the new tariff. So that's all from me. I will pass on to the next speaker. Thanks.
Thank you, Senor. Let me continue with a results reps sector report on technology. Now, the fourth quarter 25 results were largely within expectations, with 6 companies delivering inline numbers. These are mainly consist, of all the bigger caps names. Inari MPI, CITOS, Panamasters, Unisem, as well as QS reported within expectation numbers. Misses, there were 5 companies, mainly from EMS, as well as some of the smaller cap names like CloudPoint, Synergens, as well as GHM. Now, the misses were mainly due to weaker sales, margin compressions, as well as unfavorable product mix and FX effect, on the cost side of things. Now, there were only one outperformer, which was Rasa, mainly on margin expansion thanks to the economies of scales as well as a robust revenue. Now, on aggregate, I think the sector PATAMI grew about 1.3% year-on-year and 28.1% Q-on-Q. 6 companies out of our 12 companies within the coverage posted stronger year-on-year numbers in the fourth quarter, whereas 8 companies saw better Q-on-Q performance. Now, following the earnings review, we trimmed our aggregate FY26 sector earnings by about 8%. These are mainly on the substantial cuts, on SKP as well as Unisem, as we revise, the forex number as well as the break-even, expectations on the Malaysia side of things. Now, in terms of change of call, there were 3. 2, we upgraded Inari and Pentamasters to buy, whereas we downgrade SKP to a neutral. I think this is on the back of the subdued outlook on the EMS segment, as the customer cost down demand and suboptimal utilizations continue to transpire. For Inari and Pentamasters, I think are rather the same thesis. I think the share price corrections relative to the earnings contractions suggest that much of the negativity has been priced in. So this actually presents a very good opportunity for investors to accumulate quality, liquid technology name ahead of the next growth cycle. Now, revenue indicators remain encouraging. I think most companies posted year-on-year growth, except for only 2 and EMS players. I think average revenue growth stood at 3.1% in fourth quarter and 8.4% over the course of the year-to-date 25. This is, of course, despite the unfavorable forex movement, where we saw the strength of ringgit against the dollar. Now, when the trends are improving, certain companies saw compressed margins coming out from the FX headwinds as the repricing activities as well as the cost pass-through do lag by a couple of quarters. Now, overall, firmer revenues as well as the earnings trajectory are supported by the replacement cycles, the recovery in the automotive sectors, AI-driven upgrades, the strong and robust demand from the servers and peripheral demands, and power management IC requirements. Management guidance across these sectors remain constructive into 2026, with guidance on improved loadings as well as some major program wins from project transfers or supply chain relocations. In terms of outlook, I think the entering support players as well as the ATE manufacturers should see sustained growth on the rising semiconductor volume and capex cycle. OSAT players positioned for recovery, though the performances may vary, by the exposures of products. EMS segments, like mentioned earlier, should remain challenging, amidst customer cost down demands as well as limited visibilities. Whereas the software and ICT players should continue to benefit from structural trends in digitalizations, cloud adoptions, as well as cyber security. On the US-Iran conflict, I think Malaysia only has a very minimal exposure in terms of trade with Iran as well as the broader Middle East, which accounts for about 0.1% and 4.2% of our total trades. That said, the higher energy costs as well as prolonged conflict could indirectly slow the capex cycle and dampen electronic demand in the medium term. However, that is not our base case assumption as of now. We continue to like this sector, and we think you will be one of the preferred allocations as allocation into FY26, particularly for Sharia funds, backed by strengthening fundamentals, growth prospects, as well as favorable sector positioning. Now, the improving sector revenue and earnings growth momentum should continue to prevail, and the sector is currently trading at about 20 to 21 times forward PE, which is at negative 1 standard deviation below its 5-year means. We believe this is very attractive given the risk-reward ratio is favorable, with the projected over 30% growth in FY26. We maintain always on the sector. Our top picks are MPI, CITOS, Rasa, and GHM. That's all from me. I'll pass on to the next speaker.
Okay, thank you, Meng Horng. So today we have a company update on IGM post the briefing on its independent advice report on Sunway's proposed takeover on IGM. So M&A Securities, which is the independent advisor for IGM, has come up with a view that Sunway's takeover offer is deemed to be not fair and not reasonable. So looking at the aspect of fairness, which mainly lies on the aspects of valuation, it seems that M&A itself, it values IGM via an SOP valuation at 5 ringgit and 84 cents to 6 ringgit and 84 cents, which is not just above the 315 ringgit offer price by Sunway, but also higher than our initial SOP derived target price of 3 ringgit and 43 cents prior to the takeover announcement. So so basically, the main differences was that M&A Securities SOP valuation did not have a discount to RNAV, and it also ascribed a higher target PE for for IGS manufacturing division at 14 times versus ours of 10 times. But having said that, despite the offer price of 315 being lower than ours and also M&A's valuation, we still see that there is a considerable amount of premium, based on last Friday's closing price of Sunway. The current implied offer price for the deal that we calculate is at about 2 ringgit 91 cents versus IGM's last price of 2 ringgit 32 cents, which brings about to a 25% premium. So there's still some upside to it. And in terms of the aspect of reasonableness, I think M&A was mentioning about IGM shareholders not being able to realize the full value of whatever current gestating assets they have, and rather would only realize, instead of 100%, they only realize 20% of the 20.6% of the potential uplift via the proposed enlarged Sunway group. But in the end of the day, it also pretty much depends on the risk appetite of the funds, whether they could wait for the plans from IGM. And some of the new plans that they unveiled was the listing of their construction arm and also exiting India Toll Highways, which is quite a loss-making business, and this is to actually make the business structure more simplified, as opposed to now, whereby IGM Corp is an amalgamation of many businesses, and that creates a lot of noise in terms on how to reach the valuations. So and the timeline to basically, for example, list their construction arm is within a 24-month timeline. So it depends on what's the risk appetite of a investor. But with that in mind also, if we currently stick to our accept offer stance, because investors in a way are still able to realize whatever gains from the cash portion of that 315 offer price, and they would still remain invested via IGM through the enlarged Sunway group. So but should the deal not go through, we think that it should give the opportunity for IGM to really prove itself to the market, to execute whatever plans that it has laid out last week. So that's about it from me. I'll pass on the floor to the next speaker. Thank you.
Hi, thanks, Adam. So today's company update on EcoWorld. EcoWorld has entered into 3 subscription and shareholders agreement with J-Land Group to undertake 2 projects in Iskandar, Malaysia, and 1 project in Australia. The 3 projects include an 8.4-acre mixed residential and commercial development in Larkin with a GDV of 1 billion, a 316-acre industrial park in Iptec South with a GDV of 1 billion and Macquarie Park in Sydney with a GDV of 400 million. We are upbeat with EcoWorld's JV with Jayland Group, as the two Iskandar Malaysia projects will strengthen EcoWorld's presence in the area. The industrial JV project in Ibrahim Technopolis will be developed into Eco Business Park 9 or IPTEC, suggesting a clear future pipeline of industrial park developments under the EcoWorld's portfolio. Although EcoWorld is now directly undertaking an overseas project, the management has clarified that the company's primary focus is still in the Malaysian market. The tie-up with Jayland Group is strategic, as the Iskandar Malaysia region has been anchoring EcoWorld's property sales over the last 2 years, contributing to about 57% and 50% of FY24 and FY25 sales. We make no changes to our FY26 to FY28 forecasts, as earnings from Macquarie Park will be on a completion basis, while the development profit from Larkin project will likely come in only around late FY28. As for IPTEC Industrial Park project, the maiden launch may take place in 2028 or 2029. Overall, we maintain buy with a new TP of 3 ringgit and 6 cents from 3 ringgit and 3 cents, implying about 42% upside and a 4% dividend yield. That is all from us. Thank you everyone and have a great week ahead.